This is a Farm Doc Daily webinar on University of Illinois Extension's Todd Gleason. On the 8th day of February, the United States Department of Agriculture updated the monthly world agricultural supply and demand estimates. And Scott Irwin, Janzen, ag economist from the University of Illinois, join us to take a look at what those numbers might mean going forward as they're related to their grain market outlook and price prospects for 2024. Thank you both for being with us. Joe, I think probably we'll get started with you. Good afternoon to you, and thanks for being with us.
Yeah, thank you, Todd. Great to be here. This is sort of an extension of the talk that we gave as part of the in-person Illinois Farm Economics Summit meetings that happened earlier in January. But with some updated outlook based on new information that we got today and in the past month about what's been happening in corn and soybean markets around the world. I'm really happy to have Scott along with me to both provide interesting color commentary, but maybe also to tell me when I'm maybe out a little bit over my skis or I'm getting things wrong here. So we're gonna tag team this talk today, and I'm really glad to do that. Basically, we're gonna hit on market fundamentals and why we've seen the price declines that we have over the last few months. It's no secret to anyone who follows corn and soybean markets that price levels aren't what they used to be. Along the way, we'll touch on South America, farm profitability here in the Midwest, biofuels, the macroeconomy, a whole host of things that are also part of this Illinois Farm Economics Summit meetings. And there's a couple more meetings in that series that I encourage everyone to attend in the next couple of weeks. So just to kick off, I want to talk about the price history, what's been happening in these markets. Past isn't a prediction. This isn't sort of telling us that, well, we've seen a downward trend, that trend must continue. I'm not sort of calling for, I'm not trying to pick the bottom here or say this trend's continuing, but just how does the current market situation set up based on where we've come from in the past? We have seen prices fall over the course of 2023 and into early 2024. Really, you can kind of divide this price history into kind of two parts. The first part being what happened in, say, January through June, where we saw prices for both corn and soybeans decline, mainly on the news of a very large crop out of Brazil, record crop from Brazil that really kind of put a lid on what were historically high price levels until we get to the end of June. And I view that as probably the most consequential day in this price history. At the end of June, USDA released its acreage estimates for 2023. One of the biggest sort of divergences that we saw between pre-report expectations about corn versus soybean acres. We saw USDA up its corn acreage estimate from 92 to 94 million acres and drop its soybean acreage estimate from 87 down to 83.5 million acres. That really kind of changed the overall supply and demand picture, put some strength into the soybean market, and really kind of said that we're in a situation of particularly abundant supply for corn. What that did was maintain some of that market volatility in the soybean market through the fall. And really put a lid on the volatility in the corn market. You can see from sort of July, August onwards, after we had a few sort of summertime weather scares, really that market just kind of grinding sideways until the last few months when the corn market has fallen off even more. Old crop bids here in particular kind of getting hammered in the corn market. We've switched to a much more sort of abundant supply situation where old crop prices now are trading at a discount to the new crop prices for the 2024 crop. For beans, we still see a little bit of an old crop, new crop inverse as the market waits for abundant supplies to come from both South America and what we'd expect to be a reasonably good soybean crop on the basis of acres that are above what we saw last year, was particularly low soybean acres. So we'll get to that in just a second. This is the price history up to the end of yesterday. I want to talk a little bit about what happened today first with USDA's release of the WASDE report, and also we might touch a little bit on Brazil's crop estimates that came out earlier this morning, just prior to the open of trade in U.S. markets, and we'll talk about what effect that had. For corn, USDA's report estimates showed very minor changes to the U.S. balance sheet. Exports for 2023-24 remain unchanged at 2.1 billion bushels. USDA upped its ending stocks estimate for the United States just slightly, really a kind of a marginal change in ending stocks. Probably the bigger change was on the global balance sheet and what happened to South American production. USDA dropped their Brazil corn production estimate from 127 million metric tons down to 124, and left its Argentina production estimates, which are, again, much higher than the Argentine crop from last year, at 55 million metric tons, which is a fairly good-sized Argentine corn crop. What that did, we'll talk about in just a second. On the soybean side, USDA lowered its export estimate for soybeans from 1.755 billion bushels down to 1.72, so dropped 25 million bushels out of the export number. That with other changes on the balance sheet led to an increase in ending stocks of 35 million bushels. Probably the biggest sort of piece of news was what USDA did or didn't do to the South American production numbers. It lowered Brazil's production estimate from 157 down to 156, or 1 million metric tons, left its Argentine estimates, which the trade had maybe expected it might bump that number up somewhat, left that unchanged. But really that Brazil production estimate was much larger than the trade was expecting. And that definitely had an impact on the market, as we'll see in just a second. One thing to note, not listed here, is that USDA also increased its production estimate for last year's Brazilian crop, adding 2 million metric tons to the 2022-23 Brazil soybean crop estimate. And overall, kind of maybe putting a damper on some of the news that's been coming out from Brazil about, crop trouble and poorer than anticipated growing season weather. Is that a fair characterization of what the report said, or anything else that you sort of noticed in the report, Scott, that you might add?
No, I think that's a great summary, Joe. I would just add that just a continuing interesting story with soybean acreage in Brazil. And it's actually a fairly regular occurrence now that USDA will go back and revise their own estimates of Brazilian soybean crops once they get in final data on crush and exports on the Brazilian balance sheet. And then they simply ask, does that really kind of line up with ending stocks? Does that seem to give us a reasonable number there? And if not, we'll raise the production. And so that's the real story, I think, coming out of the Brazil numbers today for last year's crop and this year's crop is really acreage, not yield. And that's the overall story.
And I think going forward, it seems like we're going to see this sort of like era of dueling production estimates, and the trade sort of maybe struggling a little bit to understand what do these really mean in terms of how do we reconcile what's coming out of Brazil's own crop production estimates from CONAB and the estimates that we get from the USDA.
Yeah, and one point on that, without really wanting to go down this rabbit hole very deeply, but it's really important, I think, for our listeners to distinguish the methodology that the USDA uses to get the acreage and yield and production estimates that we're used to looking at. Those are based on very rigorous, large-scale random samples of producers and also direct observations of acreage and yields. Whereas in Brazil, none of that exists. So when you see the CONAB number or a state number down there, no one's doing random surveys. This is all based on industry contacts, satellite data, a variety of data forms. But we should never treat anyone's Brazil or Argentina numbers with the same accuracy that we'd expect of the USDA.
In terms of how they produce their U.S. estimates, which are probably sort of the gold standard.
Yeah, exactly. The U.S. estimates, even the USDA's Brazil estimates clearly have a larger estimation error than their U.S. estimates. And that's just what we have to live with.
That's a great point. So let's talk a little bit about how the market reacted. These two graphs just show corn on the left, soybeans on the right, what the market did since early this morning, since about midnight. We did see both markets, pop a little bit at the 6 a.m. hour. That's the release of the CONAB numbers. They released a number that showed much lower production, a sub 150 million metric ton soybean crop in Brazil. And so you see a little bit of a rally there, and then the market sort of pop again on the open of trade here in the United States at 8:30. And then when the USDA numbers come out at 11, we see really a negative reaction in both markets, although the corn market sort of came back here on the close. These graphs unfortunately only go up to about 12:30. The soybean market actually came back on the close as well, actually ended up trading slightly higher on the day at around above 180, somewhere above in the 185 range, I think. So overall a pretty muted reaction, and I think the trade still sort of has a lot to process in terms of what the South American crop is going to be.
Exactly.
But nothing that would change sort of, lower prices than we've seen for the last 3 years. A corn price, that's, in the low fours, and a sub $12 soybean price. So to kind of like put that in some context, we're going to just talk through the U.S. corn balance sheet a little bit, give a little bit of, this is mostly history at this point, certainly on the supply side. USDA made no changes to the supply side of the corn balance sheet for 23-24 in the latest WASDE report. That's the same as it was, looks the same as it was in the January report. And we don't see sort of any reason why those numbers change materially at this point. We have a pretty large U.S. corn crop, above 15 billion bushels. This is part of what's driving lower prices. This is a supply-driven phenomenon where we are producing more than the world needs to use at this point in time. On the use side, again, no real changes from USDA in terms of corn use for 23-24. I'd maybe point out just that in this three-legged stool of corn demand, where we're talking about feed use, food, seed, and industrial, which is really mainly ethanol use, and exports, I think there are some warning signs that we might talk about. If you look at weekly ethanol use numbers, we're kind of struggling to get to the levels that would be necessary to meet that ethanol projection of 5.375 billion bushels. On the export side, and I'll talk through this in more detail in just a second, again, I think while we've seen really pretty good export sales, especially compared to the dismal export pace that we had last year, there are some maybe warning signs that we may not get to those USDA numbers. But overall, I mean, the big picture takeaway is we're going to have, however you slice it, a 2 billion bushel plus carryout. USDA's current numbers just under 2.2 billion bushels. My projections come out just above that on the basis of maybe slightly lower use. But overall, a well-supplied U.S. corn market with a now over 15.5% stocks to use ratio. USDA's current season average price projection for 23-24 is at 480. I see some room for that to come down just on the basis of the fact that we have now very close to $4, maybe 410, 420 cash corn here in the Corn Belt. That's a number that maybe drags that season average price number down a little bit, not a lot, because again, that season average price is a function of sales that have already been made and made at significantly higher cash prices than we're seeing today. For soybeans, again, the production side of the balance sheet, the big number here that's driving what remains a relatively tight supply situation inside the U.S. is that lower planted acreage number that came out back in June. Haven't moved much from where that number was. We're at 83.6 million acres of soybeans last year in the U.S. that kind of puts a lid on production and makes the supply and demand situation relatively tight. On crushing and export, the two main use categories here, USDA did lower their export numbers slightly. I can walk through the case for that number. I think USDA has a strong case to lower exports somewhat. I may be a little bit less bearish than USDA is, in spite of the case for that number, which I'll talk through in just a second when we look at U.S. soybean export pace. Nonetheless, the supply and demand situation on old crop remains fairly tight within the U.S., the caveat being that obviously the United States exists in a global market. USDA did lower their season average price forecast for soybeans down to $12.65. I'm going to sort of stick with that number for the time being, again, on the basis of much higher prices that prevailed in the fall. We'll talk about some issues to do with marketing timing and how farmers are moving that crop to market later in this discussion. So we'll move into global markets and the export sales pace, kind of dig into that export number a little bit more. This is the U.S. corn export sales pace, that orange line there representing where we're at this year, how we've done. We came into the marketing year, that vertical pink line is September 1st, the start of the corn marketing year, with not necessarily great, very high levels of sales on the books, really kind of much more of a hand-to-mouth purchasing situation than we've had in the last few years, but strong export demand, particularly from Mexico through the fall, that got us right onto or pretty close to that 5-year average pace. However, we have seen corn export sales pace kind of slow a little bit in the last few weeks. There's a question, I think, about whether we can get to that current WASDE number at 2.1 billion bushels. That will depend in part on what we see in terms of crop progress and crop conditions for the corn crop that's really being planted starting right now down in South America. We're going to be above what happened last year. I think we can pretty confidently say, 22-23 was a pretty dismal year for U.S. corn exports. Things are better. It's important to note that's not on the back of demand from what had been one of our largest customers for U.S. corn, China, who's really kind of shifted the bulk of their purchasing in terms of their sourcing of corn to Brazil in a big way in the last few years, particularly when they relaxed some phytosanitary standards that had prevented them previously from buying Brazilian corn. On the soybean side, maybe some warning signs flashing, but still really, I think, room to get to the current WASDE projection and maybe a little bit further if we can see a few decent export sales made in the next, say, 4 to 6 weeks is really kind of a crucial time. We're kind of coming out of a period that has traditionally been a bit of a seasonal lull in January, February. But what happens with the Brazilian crop? Can we move some soybeans in the next few weeks is going to be a big part of that story. The one thing putting a lid in why USDA, I think, did lower their export number today has to do with just relative prices. We've seen export bids out of Brazil much lower than export bids at U.S. ports. The Brazilian soybeans are very competitive on the market. Now, can they it sounds also like export pace has been kind of pretty slow, getting soybeans moved to export position down in Brazil. So still some uncertainty here, but I think there is room to get to that WASDE level and maybe even exceed it in the weeks ahead on the basis of these pace numbers. But USDA makes, I think, a reasonable case for why soybean exports are lower this year than they have been in the past. Ultimately, the thing putting a lid on everything is the production numbers that are coming out of South America. And this graph just tries to put those in some context. Again, we saw USDA lower its current marketing year 23-24 production numbers for Brazil slightly. But the thing to note is even with the Brazilian crop getting smaller, Argentina is going to have a much, much larger crop than it did last year. And the initial USDA projections for this year were for another record Brazilian crop on the basis of what it thought were going to be, pretty big soybean acres coming out of Brazil. We've seen, those acres being dialed back, some yield expectations being dialed back. But still, a much more well-supplied global market. If you add Brazil and Argentina together, we've got more supplies for soybeans coming out of South America than we have in the past. Even if you go to some of the more skeptical private forecasts, you bring that production number down to say a 150 million metric tons, or what's right at 5.5 billion bushels out of Brazil, and you say, yes, there's, it looks like we're getting news about good rains coming out of Argentina in the next week or so. Maybe there's room to make that crop even a little bit bigger. The world market is well supplied with South American crop. That's what's keeping a lid on old crop prices for both corn and soybeans. We've seen particularly the soybean market sort of catch up to the corn market, if you will. Prices for soybeans falling in the last 2 months. So moving into 2024, what's going to be big? I think obviously we talk about U.S. production and what will it be in response to what's happened to markets in the last few months. This graph just shows the corn and soybean relative prices, the ratio of corn prices to soybeans in some historical context. When this number gets to be relatively high at planting time, we tend to see more soybean acres. Last year, as of February, that was what was a historically neutral signal, maybe in the context of just the last decade or so, was a pretty strong signal for the U.S. farmer to plant more corn. However, we've seen that that situation reverse this year. Current new crop futures prices suggest the market still favoring soybeans to some degree. If you looked at that ratio back in the fall, the market would be screaming for us to plant more beans, really moving towards a more neutral signal, but still, I think, an incentive to increase soybean acres in 2024 relative to 2023. On the yield side, the other part of this is, how do we develop a projection for yields? This is basically a rough approximation of USDA's trend line yield estimate, which puts the yield estimate for U.S. corn in 2024 right at about 181 bushels per acre, puts the U.S. soybean yield estimate at about 52 bushels per acre in 2024, based on simply drawing a linear trend through the yield history since 1990. So you have to say, even though we haven't reached a 180 plus yield number in the United States in our history, everything in the past suggests us pointing to higher yield numbers, and the prospect of a crop that big, of a 181 average U.S. yield, would sort of continue to fill the balance sheet, fill up the global granary, if you will. Scott, you've done some work on thinking about these trend line yield estimates. What are your thoughts?
Well, I think in terms of what we should use as our anchor for expectations, the 181 and 52 seem really reasonable. You'll see a little quibbling. Every analyst has their own kind of model, but that's right in the ballpark. I recently asked a different question because if you look in particular at the corn yields on the left, we've really been pretty flat, or some people are arguing that, that the trend, the rate of increase in trend yields has really dramatically slowed down since, say, around 2010, 2012. No, I guess it'd be about 2013, 2014. There's this somehow plateauing of yields. My response to that is, one, you have to be very careful in over projecting from short periods of time when we know they can be dominated by just the particular random weather, whether it's good or bad. I like to point out to people in that context to look at what happened from about the mid-90s to about 2007, 2008. If you look at that little chunk of the corn graph, a lot of people were talking about, oh my goodness, we're going to have 300 bushel trend yields in 2030 because of the genetics. We know that was that was clearly didn't and will not happen. So if you take the view that I do, which is, yeah, I think the black line in the middle, somewhere around that's still as good of a representation of trend yields as we can get. Well, if that's true, then you can ask a really interesting question. How high could high be for the U.S. average corn yield? And so in this work I did, I just arbitrarily set the bands at plus and minus 10 bushels per acre. And I think a lot of people would be very surprised that this history suggests there's a 1 in 5 chance of a positive trend yield deviation in 2024 for the U.S. of plus 10 bushels an acre. Now just do the math. Plus
181
10
plus 10
is 191. And I think the data say that, and I believe in that trend, that means that we have a 1 in 5 chance of a trend yield of basically 190 bushels or higher. And a 190 yield would put us well over a 16 billion bushel corn crop. And again, I want to be careful. I'm not saying that's going to happen. That there's basically an 80% chance of something lower than that yield, but 20% chance is something that we should be aware of. And it's just a reality check on your thinking. We just want to make sure people are not underweighting the chance of something like that happening because of what you see in recent years, which I would argue is dominated by less than stellar weather in the U.S. and different parts of the Corn Belt. So that's to me the lesson. It's not that that's going to happen, but don't go to sleep on the possibility of some really big yields.
Yeah, and we're just getting a question in here that I think is germane to the discussion, which is the trend line yield purely statistical, or does it factor in agronomic changes and developments? And the answer is no. I mean, what USDA's methodology is, in a sense, purely statistical. It's purely taking, running a straight, the line of best fit through the historical data and projecting it out another year. Now, and the important thing to, I think, remember is that methodology is, in a sense, accounting for the fact that we've had, sort of kind of limited yield growth in the last few years. We have sort of bent the curve down or pivoted that line down slightly. But again, the beauty of that methodology is it doesn't sort of overweight one year. It doesn't overreact to 1 year because it's taking a long run average, in this case, about a 35-year average. So each year can only count for 1/35th. Important to note that we took 1988 out of that average relatively recently, and that helped kind of bend that line down a little bit.
The other point I'd make is, just to be clear, a lot of people want to connect directly yield histories to particular genetic improvements, management changes, machinery, et cetera, et cetera. This does not do that. It's incredibly hard to do that. So think of that trend line as just the average of all of the technological improvements that have gone into U.S. corn or soybean production. And you cannot map that to any particular development or technological improvement in genetics or management.
Yeah, it's important to note that, this number is the composite of a lot of factors that are affecting U.S. corn yields. Some of them great, some of them like technological improvements, new varieties, new management practices, but also the drag we have because we encounter production difficulties all the time in terms of new diseases, pesticide resistance, et cetera. And so we're not going to try and overread any one of those things or sort of overinterpret anyone. Okay, so that's where we can sort of see, again, the possibility of a continued, not supply glut, but let's say a well-supplied corn and soybean market in the world. What potential are there for sort of usage categories to come along and kind of eat into that global stockpile? This graph just shows the composition of U.S. soybean use. And the point that I wanted to make here is just that we really kind of, again, need to see broad-based demand growth to kind of use this thing up. and the potential for something, particularly biofuels, as one use to kind of be the savior in this case is fairly limited. So if we just look at how do we use the U.S. soybean crop, we have historically used about half of that for exports, and half of that for domestic crush, which gets split into meal and oil. We've kind of started to move towards a more domestic dominated US soybean market in the last, say, 3 or 4 years. Some of that is demand for bio-based diesel, both renewable and biodiesel products. There's been a boom in new crush capacity and the thought to crush more beans domestically to use up in biofuels. We've seen the share of US soybean oil use for biofuels grow from about 35% back in 2019-20 to about almost 50% today. But it's important to remember that even that growing biofuels use is still using up about 215 million bushels of US soybeans. If you think about just that component alone, the number of pounds of soybean oil that we're producing is pretty limited as a share of all of US soybean use. So to again eat into these kind of supplies, to more closely match supply and demand, we're going to need to see some kind of broad-based demand growth. We'll sort of talk a little bit based on the balance sheet about what we see that looking like going forward. So then this just tries to put together some early numbers for the 24-25 balance sheet, the crop that we'll be planting this spring here in the United States, and then marketing into 2025. The first two columns show last year's and this year's balance sheets. The third column shows USDA's very early what they call a baseline projection for 24-25. Every fall, the USDA puts together a long run projection of U.S. commodity supply and demand for all major crops, including corn and soybeans. They projected a long-run corn plantage acreage number for 24-25 of 91 million acres. They actually see corn acreage kind of dropping going forward into the distant future. They see, again, a trend line yield projection of 181 bushels per acre. I think there's no reason to sort of deviate from that yield projection. I think we may still see pressure to plant acres. Our latest crop budgets here from the University of Illinois showing pretty dismal margins on corn. However, enough to still cover variable costs, and there will be, I think, pressure to outproduce low prices that'll maintain corn acreage. This is still an acreage decline relative to last year, a pretty significant one, but maybe not as large as was projected by USDA. On the usage side, USDA building in pretty strong increases in both feed and residual and food seed, and some increase in food seed and industrial use. A pretty flat ethanol demand. Their long-run ethanol demand projections, again, pretty flat. The potential for something like sustainable aviation fuel, which has gotten a lot of talk in the news lately, to be a part of this 24-25 balance sheet, I think are pretty limited. So the real action might come here on the export side. While I'm a little bit more skeptical about corn exports in the last year, I think there is some room for optimism with lower prices and the fact that we have probably our best export customer really right next door in Mexico. I think there's potential to maintain U.S. corn exports. Nonetheless, this kind of production that returns to trend line yield really builds stocks, and there's no sort of two ways about it. You'd have to really see, again, another year of kind of mediocre U.S. corn yields to get us to a situation where we don't grow ending stocks and we don't increase the stocks to use ratio. USDA put out a season average price projection of $4.50 back in November. I've lowered that slightly here. USDA sort of sees that price on a glide path down to their long run price level of about $4.30 per bushel. I don't think we get quite all the way there this year. Now the sort of one caveat here is if we see that very large crop, we're also going to have to see a price that moves much closer to or below $4. This is an average price projection based on average crop conditions. A large crop would certainly have to, you'd think, require lower prices to ration that big global stockpile out. On the soybean side, USDA did project substantially larger acres for 2024. I think there's room to even increase that further on the basis of just sort of what we're seeing in terms of relative crop budgets. I see a much bigger shift into beans relative to the change in corn acres. The trendline yield projection, again, 52 bushels per acre. That gets us to a 4.8 billion bushel total supply, about a 4.5 million bushel crop. We'd see, I think, already projections for a strong domestic crush use in 2024. I've increased that even more to 2.4 billion bushels in these projections. Reduce that export number slightly, and again, the thing to note here is that the U.S. is a competitor up against a relatively a big producer, can be not necessarily still a low cost producer in all cases, but a producer that has incentive to produce a lot in Brazil. And I think the export market is going to be pretty competitive going into 24-25. All of that gets us to a building stocks situation that's not sort of huge. These aren't huge stocks. We've seen, billion bushel plus carryout for soybeans in the U.S. in the not too recent past. I think we're more building towards that with the caveat that the global stockpiles here are also growing. My colleague Joanna Calusi and I talked a lot about this last week when we did our webinar on South American production situation. You can go back and watch that on YouTube. But the global supply and demand picture really filling up on the basis of a decent crops both in Brazil and the US projected in the next year. That gets us to a season average price projection based on sort of current futures prices and USDA's long run projection of $11.30 per bushel. I want to take a pause and sort of think a little bit more about, what does this mean for farmer marketing? I've heard lots of stories this fall about farmers sitting on pretty significant stockpiles of grain. Obviously, in a situation of declining prices, there's room for a little bit of regret about not having sold grain at higher prices that prevailed earlier in the year. So I want to sort of maybe offer some solace and some encouragement as we move into a new marketing year, thinking about what we can do in the presence of lower prices and tighter margins. And this is a hard question for marketing because there's just simply more randomness in marketing performance across farmers over time. Studies that we've done here on the Farm Doc team looking at marketing performance versus financial management versus operational performance suggests that there's just sort of that marketing is just not as repeatable a skill as maybe other aspects of farm management. So my simple recommendation, based on some of the data that we've looked at on marketing performance by Illinois corn and soybean farms who are members of our Farm Business Farm Management Association, is to consider all opportunities to market grain, both pre and post harvest. And the data suggests to us that a lot of farms really aren't conducting significant marketing activity or realizing market sales at or shortly after harvest. So this looks at year end, calendar year end, how many farms, what proportion of farms have realized sales, how much of their production have they sold as of that calendar year end date. And we see that somewhere between 40 and 50% of producers in any given year, and this is repeatable across years, have really realized no sales. They might have some forward sales on the books for delivery after January 1st, but they're really not moving a lot of grain at harvest. About half of these farms realized no new crop sales before January 1. And I think this really might constrain the farm, particularly in a low margin environment where now you're in a situation like this year where you've got to make some sales at prices that just don't feel good to make sales at. how, you might say, well, on average for these farms, they've got no sales, but they're doing really good. They're making, gains relative to what they could have sold that crop at prior to January 1. And to that, we've looked at sort of, what prices do these farms realize compared to their marketing performance earlier in the year. So for the farms that were actually selling some grain prior to January 1, how do they actually realize higher prices on those post-January 1 sales? Data from Illinois FBFM suggest they do, on average, realize a slightly higher price, but the range of outcomes is really wide. And a lot of farms are actually doing worse selling after January 1 than the prices that they realized before that date. So the average realized return, excluding any storage costs that farms might incur, because we don't know exactly when this grain's getting delivered and we can't sort of calculate storage costs exactly, but just comparing gross returns, prices to prices, the average return's about 6 to 7%. If you think about this on a risk-adjusted basis, on the basis of the fact that you could be realizing, the possibility of negative 20% returns, these returns appear to be relatively poor. If we start to think about what's the cost of waiting, we think about, what's just the cost of capital on the grain that's being tied up in storage, that farms have tied up in storage, particularly in an environment like we see now with rising interest rates. We've seen, benchmark interest rates like the Fed funds rate, given here in the blue line, up about 5% in the course of the last 2 years or so. Loan rates at the farm level, looking at, say, farm operating loan rates, growing by about 4% over that same period. That increases the cost of capital for farms thinking about holding on to grain after harvest. And so in that kind of environment, I think farms have to, again, really think hard about diversifying their marketing to the extent that they can, making some pre-harvest sales, and thinking about realizing some sales prior to that January 1st deadline. We know there's some tax implications involved there, but giving yourself as much flexibility as you can so you're not sort of hemmed into a particular marketing period is helpful. Okay, so with that, we'll sort of just give a few brief takeaways before we get into questions and hear what you have to say. On old crop, again, the corn supply situation is a situation of high stocks. That's going to mean low volatility. I think a lot of farmers waiting for that, one rally that gets them an opportunity to make some sales here in January, February, March. We haven't seen it in a high stocks environment. That rally is not going to look like the dollar a bushel rallies that we saw back in 2021, 2022. There is some limited opportunity to capture some carry. You've got about 20 cents of carry between March and July futures. It's not an amazing return, but it's something that the farmer can realize if they're willing to commit to sales later in the marketing year. On the soybean situations, U.S. stocks are still sort of historically tight, but we're kind of in a situation where export prices out of the U.S. are uncompetitive with South America. A pretty flat carry structure. We could see, maybe I think more of an opportunity for some kind of rally on soybeans now than we might see with corn. But the market moving to a much more sort of well-supplied situation on old crop. For new crop, again, most fundamental factors, whether that's news coming out of South America, what you have to think about projecting U.S. Production going forward, all of that pointing to a period of low prices for longer. And we're building that into our farm profitability projections here on the Farm Doc team. The market is moving towards maybe a slightly more neutral corn to soybean price signal, although it hasn't changed a whole lot in the last month as both corn and soybean prices have fallen. So the sort of maybe takeaway message for the farmer is, have a strategy that accounts for some of the possibilities of some of the things that we've talked about. The possibility of a large U.S. crop that might, significantly dampen prices. A marketing strategy really is a commitment device to say, I will do this if that. And I think that's some combination of forward sales and target orders that commit you to acting at particular prices. Store and ignore, or sort of waiting for, continuing to wait is an expensive strategy, particularly in a high interest rate environment. At sort of 8.5% interest, the cost of capital eats up a lot of the gains that might accrue from waiting to market at higher prices. We do see, room for some price appreciation through this old crop marketing period, basis being slightly better for delivery later in the year, but the cost of waiting is just getting pretty high. And I think farms have to think about moving relatively aggressively on old crop and focusing on the new crop marketing challenge going forward. So that's what we have in terms of presentation today. We do have 2 more webinars in the IFAS series. I'll let my colleague Todd Gleason talk through those and some of the other events that we have coming up on the Farm Doc calendar. Thank you.
Indeed. Hey, thank you very much. A couple of things that are coming up. These are part of the IFA series, which you're watching at the moment, and you should be signed up for them already. Coming up on the 15th of February, Jonathan Coppice will talk about farm policy, the current state, and a quick look ahead at what the calendar might look like as it relates to Farm Bill now 2024 as opposed to 2023, when they might be able to get things done and how things would have to move in Washington, D.C. It should be a really good primer. If you've not listened to Jonathan speak before, you'll want to join us for that one. And then Scott Irwin will return on the 22nd for the renewable diesel boom. This is the last of the IFAS series webinars. What does the future look like there? He's made this presentation a couple of times that I've watched. And if you've not seen it before, even if you have, it is clearly worth taking a look at to get an idea of how renewable diesel has come into being, what the policy stack looks like that supports it, and what he thinks about the capacity to turn renewable diesel out and soybeans and the crush in the United States might be. So join us for those. There is one last item that's on the list as well. We'll get to this crop risk management webinar. Before we get to that, go ahead back to the crop risk webinar. On Monday the 19th, Gary Schnicke and Nick Paulson, and then on Monday the 4th, Bruce Sherrick and Nick Paulson will do a crop risk management webinar series. It's a 2-part series that'll provide that in-depth analysis of risk management decisions and strategies for the coming crop year. You won't want to miss what they have to say. You can scan that QR code. We'll try to put that back up so you get a chance to take a look at it as well. And then on the 5th day of March, the All-Day Ag Outlook is coming up. That's at the Beef House in Covington, Indiana. I don't really know whether we have a slide for it or not. Probably not. But on the Farm Doc Daily website or at the willag.org website. And oh, by the way, if you have questions, do put them into the question box now as I'm going through some of this. You will find a way to register for the All-Day Ag Outlook. If you've not been over to the Beef House for this event, it's been running since 1991. The brokers that I talk to on the radio every day will be there. There'll be 8 of them. The Farm Doc team will be there to talk about grain and outlook, including Joe Janzen, and then the crop insurance decisions that needed to be made and the ARC and PLC decision, all of which I think are really important for this year as well. And then we will talk not about renewable diesel this time around, but sustainable aviation fuel. There is a Center for Sustainable Aviation here on campus, and its director has some direct links with folks that are working with SAF. You probably saw the Lanza jet announcement, I think, in the south of the jet fuel production facility. He works with them some as well, so you want to be there for that. You can sign up. The cost is $40, either at farmdocdaily.illinois.edu or willag.org. And we are doing a monthly series on, just being safe on the farm. And if you want to sign up for that, of course you can as well. Cultivating Caution is the name of it, a monthly guide to farm safety and health. Those will run, I believe, through the month of November every month. So check out Farm Doc Daily under the IFAS and webinar series, and you will see them all. Our thanks go to our sponsors today, including the TIAA Center for Farmland Research, Compare Financial, Corteva, Farm Credit Illinois, the Illinois Corn Growers Association, the Soybean Association, and FSU. grow, Mark. And thank you for being with us as well. We have a question from a friend of mine, John Hawkins. Hi, John. Thank you for putting a question in for the day. Will weather, he says, during the planting season bring a potential rally? Farmers and others who are owners of crops are always wanting to depend on a good weather rally to make a sale. Although sometimes they don't, Joe Janzen, make the sale. But is there an opportunity yet for planting season to bring a weather rally? And I think it's the time period that he's really wondering about.
Yeah, so I think, I mean, the short answer is obviously yes, it's possible. And the question a little bit to dig in a little bit more is sort of, well, why and when, and how long might it last? We typically see a seasonal peak in new crop futures of very, relative to the overall variation in crop prices across years, it's kind of small, but we typically see the market often put in seasonal highs in that period, say May through August, when we have weather in the US. So that new crop futures price, say the December corn futures price, oftentimes has a slight seasonal peak. It's maybe slightly above the price that ends up prevailing later at harvest, but it's relatively small and it's subject to considerable risk. So farms have to be sort of ready and willing to act if one of those rallies occurs. Scott?
No, I mean, I think you captured that. I think I wanted to go back and make a point, Joe, about when we were talking about marketing strategies, because I think the current time is one of the most difficult for farm marketing of crops. Basically, the outlines of your fundamental strategies for marketing crops is opposite, depending on whether you think you're into a long-run bullish market environment or a bearish market environment. And when we flip from one to the other is maximum danger for marketing strategies. And I'm not saying it's easy to know when that switch gets flipped. But I think, again, we have to be really careful right now because we've just come out of 4 straight crop years where every situation has ended up favoring waiting. Mm-hmm. Store and ignore has been the best strategy the last 4 years.
It worked really well until this year. Yeah,
until right now. And so I lean towards that we're returning in some way, shape, or form to either stagnant or a true low price environment. And if I'm right about that, there will be more rewards to larger pre-harvest opportunities. And if you want to put yourself into the frame of mind of, well, why, my forward bid's only $435 for October 2024 this fall, my gosh, I can't sell at that price level. Well, think about, what if we would get 190? With our current acreage projections, that would put us over a 16 billion bushel corn crop, and we would clearly be over 3 billion bushel carry. And we would be looking at, unless something really disastrous happens in Brazil with their second crop corn, probably fall prices well below $4 a bushel. We're not that far already. And I just think it's important to put yourself into the right frame of mind. And there may, I would say right now, it's unlikely that we'll see a rally this spring that will return us to anywhere near profitable pricing opportunities. And if we get good weather in the U.S. this summer, these will be among your best opportunities, even though they look like super low prices compared to what we've experienced most of the time the last 4 years. So I think it's a time when we kind of need to move the window of our expectations about what are good and poor marketing opportunities is really what I'm saying.
Yeah,
I guess we have another question, Jim.
We do. The question is, the last drought monitor map that this person saw showed west of the Mississippi with more drought than Illinois. Could this hold into late spring and help with a rally?
I mean, I think we've seen areas in the United States with poor crops in all of the last number of years. I don't think that's been the thing that's been materially driving the overall supply and demand balance. And so like a regional drought or regional sort of poor weather conditions in the US are probably not the thing that sort of lights a candle under this market. And to Scott's point, it's really going to take something bigger, given just sort of that this is a global market, and Brazil can fill in a lot of, and Argentina fill in a lot of the gaps that might be created by a regional weather situation here in the U.S.
You know, my response to that, Joe, is yeah, sure, the U.S. could have a 2012 style drought this summer, and that would change everything.
Yeah,
even with the big South American crops, but it takes a really, really nasty Corn Belt wide drought to do that. I think it's your point.
Yep.
The other point I would make is, yeah, I know it is really dry in parts of the Western Corn Belt. In some areas of Iowa have been exceptionally dry. And there's been some relatively large droughts in the western half of the United States in recent years that make some people nervous. My response to that is, I haven't seen any evidence that weather during the winter months, late fall, winter into spring, have much, if anything, to do with the yields that we end up with after the following summer. That's my bias. I did a Farm Doc Daily article last fall talking about, well, what were the most important drivers of corn and soybean yields in the U.S. Corn Belt? And the answers are not at all surprising. It's mainly July precipitation and July temperature. The other variables, there's other things that are important, but those two plus planting date, year in and year out, are what drive corn and soybean yields in the United States. Not saying other factors don't contribute, they certainly do, but it's really summer weather that determines the vast amount of whether you're above or below that trend we showed earlier.
And for what it is worth, the meteorologist and I talked to 5 of the best of them, I think, on the radio, and have for about 20 years, are in agreement on one item, which is that past performance does not especially pertain to the change of the season. So that dry conditions in the fall, and even if it lasts through the winter, might have some indication as to what the spring will look like. But usually the spring change will bring rains. And so even if it's dry, it's likely to change in the coming springtime. One last question, this one from me, and I get it a lot as of recent. Many farmers saw a larger price bump if they were to use price later contracts. And I'm wondering how that impacts where the grain is being held, meaning it's now in the hands, those bushels are in the hands of the elevator system. And I don't know how many of them, but do you suppose that's large enough to make a difference in the marketplace?
So just to be clear, you're saying that using deferred pricing or price later contracts kind of helps sort of get grain flowing through the system?
Yeah. So the point being that last fall that they could use price later contracts, there was a bigger premium for that, and most elevators will tell you that they have many more price later bushels in the system, so they can market them, but they're not actually shown up as sold because they haven't been priced yet.
Yeah,
So,
and I would only put to that I think there's just more bushels everywhere, and that's the problem. And so to the extent that you'd think, well, maybe there's less stocks or sort of less of an overhang on the market because grain's moving into the system. I don't think we're there yet. I think there's just a lot of grain and more grain than we have sufficient demand to use up in this marketing year and into the future.
Finally, one more question. Listening to you today seems like PLC has a better chance to pay well versus Ark County. I know Nick Paulson and Gary Schnitke will have been talking about this some, and they've already talked about it some. Do either of you have experience with this?
I'll only say that the price guarantees under that program are not projected to pay out at current price levels. So we would have to see one of those sort of catastrophic kind of situations for PLC payments to occur. Ark County can be triggered with a poor production season where PLC payments wouldn't be made. And so I think the idea that one has a higher probability than the other is not necessarily the case at this point.
The only thing I'd add to that is right now the analysis that great analysis our colleagues on the Farm Doc team have done and are doing lean towards Ark County based on historical probabilities. But you would really probably only want to go heavily or really lean towards PLC if you were really concerned about the big crop scenario and you're dropping prices for corn, say, into the mid threes. If you're really worried about that, and you think that has a higher than historically normal chance, then that's when PLC will pay off better.
Yep.
Thank you all. We appreciate you being with us today, and our thanks to Scott Irwin and Joe Janzen, agricultural economist from the University of Illinois. Remember, you can find this webinar as an archive later today, I'm sure, up on the YouTube website at youtube.com/@FarmDoc. Jim Bolts will take care of that. As you exit, make sure you also fill out that survey, and we will see the answers to those questions and what you have to say about today's webinar as well this afternoon. You have a great day. I'm University of Illinois Extension's Todd Gleason.